I'd like to introduce our next keynote presentation here today. We're very thrilled to have Brent Todd from Canaccord Genuity giving a presentation titled Investing in Small and Microcap Companies for Superior Returns. I promise I memorized that. Brent, take it away, man.
I'm Brent Todd, Senior Investment Advisor with Canaccord Genuity. Suffice to say, I'm not sure that there's anyone in this room who's been investing in microcaps longer than myself. You'd be right there, Paul, for sure. So I've been at this over 35 years. My client base comes to me, and all we invest in is microcap companies. We don't buy bonds. We don't buy mutual funds. We don't buy ETFs. We are microcap specialists. So today, presentation, I'm going to talk about microcaps and the case for investing now, and then also some investment tips, not stock tips, but some things to look for when you're out here looking at these various companies that hopefully will help you all to make better investment decisions. So unlike some of my past presentations, this won't be a presentation of my greatest hits. So which companies are to be considered? Generally, microcap, we consider companies below 100 million in market cap. These are generally businesses that we're talking about, as you can see from this presentation today. Some with assets, some not. A lot of them have revenues, some don't. Some businesses have positive cash flow and some don't. We're not going to be talking about junior mining and oil and gas and exploration companies. That's a different topic and requires a different expertise. So basically, this is the rallying cry. The time to invest is now in microcaps. Why now? We've been in a 2+ year bear market. To my mind, we sort of topped out. You can see at 1100 on the venture exchange. That was March of 2021. So we're 2.5 years into the current bear market. You can sort of see that we're just bumping along bottom for about the last 8 to 10 months, slightly below 600. So it means we're trading at, arguably 52% of where we were, or we're off 47% from the highs. So probably a good time to start looking at microcaps. Why invest now? I just want you to consider that a lot of companies that are listed on the exchange, when times were good from 2013 to 2021, when we lived in a very low interest rate environment, that a great deal of companies were able to raise a great deal of cash. Now, not all of these companies have squandered their cash. So there's a lot of companies out there that are sitting on full treasuries that have profitable businesses and are worthy of your investment dollars. Also, during COVID, a lot of businesses got funded or bailed out during that period. So even that wasn't as bad a period as most people would think. So do consider there's a ton of companies out there with large cash reserves. We're buying some companies at discounts to the cash and the securities that they hold. They have profitable businesses to boot. It's kind of a shooting fish in a barrel scenario. The other thing, another case to be made right now is that the Canadian dollar is trading at 8-year lows. Most Canadian listed businesses do the majority of their business in North America, and a lot of them do the majority of their business in America. So with our dollar being low, our expenses are in Canadian dollars. We're selling to U.S. companies in U.S. dollars. There's a great delta there. So look for some of those companies. Also, in North America is the strongest economy in the world right now. Where would you rather look for businesses that are potentially to thrive, right? A further trend that I think is huge and not a lot of people are picking up on is that there's a great deal of re-onshoring going on in North America. COVID, China shutting down, supply chain issues. People are bringing stuff back to North America. They're bringing plants back here. It's a great deal of business to be done. And who's going to benefit? Probably North American companies. Lastly, the Inflation Reduction Act, the CHIPS Act, that's been passed through the House and the Senate. So that's a done deal. There's going to be $1 trillion spent on infrastructure, on bringing these plants back, on bringing semiconductor production back to North America. That money is going to flow for the next 4 to 5 years. There's many, many businesses that can take advantage of that. So it's a great time to be out there looking. We'll go to the next slide, Sean. Many Canadian listed microcaps are more reasonably valued than large caps. It's true. The average PE right now on the S&P 500 and on NASDAQ is about 23, 24. Some of the, four horsemen of the NASDAQ, Tesla is be trading 80 times earnings. NVIDIA is trading more like 100 times earnings. We're finding companies that are trading as low as 5 or 6 times earnings. You might find some of those companies here in this this conference. In a recession, PE ratios can go as low as 12, 13. That would imply some downside for the S&P and NASDAQ. Doesn't really imply any downside for some of the companies that we're talking about. Some microcaps are trading at a significant discount to their book value. We've got one company right now. We buy it at 45 cents. If they close their doors tomorrow and sold everything, there'd be 90 cents in value there. And this is a profitable business. I mean, it makes 10 million in EBITDA. We're just buying the shit out of it. It's silly. So they're out there. I won't belabor that. So right now, this is one of the 3 best buying opportunities that I've seen this century. I think one of my slides back there, I forgot to mention it, but the 2 best buying opportunities in my career was the tech wreck of 2000, 2003, and the Great Recession of 2008, 2009. While those periods were like hard as a broker because stocks were down, you had clients' portfolios that were down, the companies that we bought during those periods were the backbone for returns for our clients for years. And I don't just mean like 2, 3 years. These are companies that we bought at 30 cents that ultimately went to $5, $7. And the only reason we could buy them at 30 cents was because the market was shitty. That's where we are right now. So this is the 3rd best buying opportunity I've seen in my career. I've been at this a long time. It's time to pay attention. Also, the economy has certainly been more resilient than envisioned. So, we got to factor that in, that some of these businesses are doing quite well. So lastly, the argument to be made is that the worst is over or nearly over. The interest rate cycle, rate rising cycle, is probably closer to the end than the beginning. In the last 2 years, I read a lot of management discussions and analysis, MD&As, all the time. And it's been littered with COVID, supply chain issues, inflation, labor shortages, the war in Ukraine, China shutting down. Now, these CEOs weren't lying. They were all huge issues for those businesses over the last 2 years. Okay? Like, we've had a confluence of events over the last 2 years. Confluence is a wonderful term where basically 4 or 5 things come together to make a worse thing than any one. Well, that's what's happened out there. But I can honestly say, in discussions with businesses and CEOs, and we talk to them a lot, is that a lot of that stuff is abating. Okay? So keep that in mind. The market's been killed, share prices have been killed, but the business environment has slowly gotten better. Combine that with interest rates hopefully being close to finished in terms of raising, I think there's a good environment to start putting some dollars to work. So that's the end of the rallying cry in terms of why now. Now, you know, I'll just go into some observations, some investment tips, if you will, that I've, you know, honed over the years in terms of doing this for a number of years. And hopefully you guys can get something out of that. Use it when you're looking at the businesses. So firstly, the cornerstone of my investment philosophy, pretty simple. The surest way for a company's share price to appreciate is to produce an ever-increasing stream of profits that shareholders may participate in. It's true. I've yet to see a company that raised revenues and ultimately raised profits where the share price didn't go. So when you're looking at these businesses, look at their bottom lines, ask yourself how they're going to rise, and if they're rising, should you get aboard? So we have a saying in MicroCapville that the average microcap success story is a 10-year-old overnight sensation. And I've experienced this many, many times in my career where the company bumps along trying to figure out what they are, what their product is, who they sell to. It's confusing a lot of times, takes patience, they wear out their investors' patience. And then sometimes, against all odds, they figure it out. And all of a sudden, that 30-cent stock that sat there for 10 years goes to $2 inside of 2 years. So when you're looking at these businesses, ask yourself, where are they on that line of figuring it out? And are they turning a corner to sustain profitability? It can't just be 1 or 2 quarters. You know, no one rewards a microcap for 1 or 2 quarters. They have to put together a year, 18 months, show that the things are going in the right direction. Okay. Sometimes some businesses, just by being in the game long enough, sometimes it's just their time. I've seen that where, you know, whatever it is they sell, produce, just becomes their time and that company gets on a roll. And lastly, look for a catalyst to their profitability. You know, we just, I think Grid was just in here before. They've got new products coming out. Is that a catalyst to increase their profitability? So look for those catalysts, look at the businesses, and most importantly, ask yourself, is this going to make them more profitable? Because that's what's going to make their shares go up. So there's this saying, you know, if you build a better mousetrap, the world will be a path to your door. You know, it is bullshit, okay? More investors have lost more money investing in what they think is a better mousetrap. The reality is a business, a stock, a company, it's all about selling the mousetrap. And not just selling the mousetrap, but selling it profitably. Some businesses, some things are too far ahead of the curve. I found in investing being too far ahead of the curve is just as dangerous as being too far behind. So these are a few things to notice. Don't get lured by a better mousetrap. Ask management how they intend to sell it. And specifically, I think we've all seen this, where the inventor of the mousetrap is now the guy in charge of selling the mousetrap. Generally a disaster. Okay, so the first slide here is an analogy that I use to describe startups and microcap businesses. And basically, it's like rolling a big, heavy rock up a hill. Now, the bulk of the management teams that I come across aren't as muscular or athletic as this individual. So a lot of times they've got to rest, Sometimes the ball goes backwards down the hill and things take longer than anyone / investors, friends, family would like. That's the average, that's the success story that takes 10 years. So that ball is constantly being worked on, constantly being moved up the hill with the goal that maybe at some point the ball will get to the top of the hill and start rolling by itself. As an investor, I've been in a few companies where the ball got to the top of the hill. It's a wonderful thing, and the ball starts rolling by itself, and the company starts making more money than you anticipated. So here's a picture of the ball rolling down the hill. Now, the one thing I will say is when it gets to the top of the hill and it starts rolling down the hill, is that it can roll a lot longer and further than you ever think. Once a company's figured out who their customers are, what their value proposition is, and they start mining that vein, let your winners run, because they can run a long way. By the way, anyone heard of zorbing? Zorbing is like where you get a big ball and you get put into the ball and then they roll you down a hill. So another little tip, because I've done it, is don't zorb with your wife in the ball. Big mistake. Okay, so basically the growth can be steep once the company's figured out who their customer is. Don't be quick to sell that winner. Once a company's demonstrated growth and growing profitability, the ball can roll down the hill. So I guess we kind of covered that. Another, subtle thing, but it's always, the D word, dilution. Some of my best successes have come investing in companies that got it figured out inside of 40 million shares. It's a generalization. Trust me, I know there's going to be some company here with 200 million shares are going to say, we're on our way. And they might be. But a company with 40 million and ideally 25 million shares, consider this, for a 25 million share company to be profitable and figured out who their customer is and be selling and on their way, for it to be $100 million company, that'll be a $4 share price. Now, I've had a few companies that got it all figured out inside of 25 million shares, and voila, they went to $5, $7 from like 30 cents. So, be cognizant, dilution does affect upside, so just another investing tip. So we got a quote from Wayne Gretzky when describing his success. He said, I skate to where the puck is going to be, not where it has been. So I like to kind of think of that same when I look at businesses. I want to talk to the CEO of the company and try and figure out where they're trying to go to. I can look at their financial statements and see where they've been, but I want to see where they're trying to go to. And once they share with me where they're trying to get to, I'll work backwards to see if that implies some upside on their share price. Okay, so if this company's successful, I could understand how they could be a $2 stock. Does everybody get that? Right? And if the stock is trading at $3, that wouldn't be good. But if it's trading at 50 cents, then maybe that's worthy of considering your investment dollars. So try and figure out where they're going. Keep in mind, you're going to get a quarterly report card to say if they're on their way towards that goal. So, very often, sometimes we see companies that are 100 million market cap, and I'm like, they've got to execute like hell just to be worth what they're worth today. Chances are you want to avoid that investment. So I've got another quote from Wayne Gretzky. So, Great Britain has Churchill and the U.S. has Mark Twain, and we have hockey players. But it says you miss 100% of the shots you don't take. So, if you come across some companies, and I'm finding quite a few of them right now, where you can convince yourself that there is like zero downside to owning this company, and yet there's at least 50% upside, or there is upside, I think you have to make that investment. Like the company I talked about earlier that we're buying, it's, management owns a lot of shares. They're not going to drive it into a ditch. The breakup value is 2x what I'm paying. You got to buy that stock. So don't be cute. Don't be trying to time the market. It's a mug's game. Right now is the time to look for these great values in these mispriced businesses. You find a mispriced business right now, buy it. Okay, so I'm gonna talk one case study about a stock that I started buying a couple years back or a year and a half back, and just because it sort of brings in a lot of the themes that I was talking about. So here was the stock, the ADF Group. They're out of Montreal. They basically design and engineer and then procure and manufacture steel for construction. So these are non-residential. This would be big plants, airports, convention centers. These are big projects, okay? So out of Montreal, they got about 600 employees in their plant. So if you look back sort of like 2020, this company lost a nickel. And then 2021, they made like 21 cents. In 2022, they made 46 cents. Q1 of this year, they made 16 cents. So we've got that ever increasing amount of profitability. We got a company that went from losing money to making money, some of the catalysts that we talked about, right? And look at their share price. So we started buying around $1.50. We're still buying today at $4.50. Now, why are we still buying up here? Well, we've talked with management. We read their MD&A. We figured out what they're doing, what they're trying to do. So last year, this company borrowed $30 million and automated their plant. Okay? So what used to take 11 hours to do a beam is now taking 1 hour. This is not only cutting their manpower and their costs, but it's allowing them to go after a ton of business that before they couldn't go after. There was no margin in it. So now their pipeline, their addressable market is much larger. So we still think there's lots of room to go for this company. And lastly, the first quarter of this year where they made 16 cents a share, which was like $5 million net income after tax, 10 million EBITDA in the quarter. That company only used the automation for about 30% of the work they did. Ultimately, they believe they're going to get up towards 70-75% of the work. So there's still lots of room for margin expansion here. Some of the other trends, re-onshoring that we talked about in North America, infrastructure spending. So they're going to benefit. Plants are coming back, gigafactories. People want their supply chains closer. They're going to need plants. They're going to need steel to erect these plants. This is their business. So, we're sort of tying in all those themes. Oh, and they only have 32 million shares out. So at a buck, this was a $32 million company. So hopefully that you can kind of see all of those kind of themes that I've been sort of harping on and talking about. But clearly, here's a business that now has figured it out, has got on a roll, that I believe will stay on a roll. Careful, don't go out and buy this today, tomorrow, whatever. Their Q2 is coming out tomorrow morning, so I'm a bit of a high wire act here because we'll see how it goes. But I fully expect it to be a good quarter because there's more automation is going to start to affect the bottom line. So remember, this thing was $1 like what, 2.5 years ago. Oh, by the way, why did they lose a nickel in 2020? COVID, 650 guys in a plant, but they had a huge backlog. So 2021, it starts. These are the type of things you're looking for. So we'll contrast that with NVIDIA, which has been like the phenomenal stock of NASDAQ, of anything out there, gone from like 200-300 billion market cap to 1.2 trillion. It was the same thing. It was trading around 100. Now it's trading around 480. So similar type of return for both companies. I don't know. Personally, I'm going to stay with the company trading, 7 times this year's earnings versus the company trading 100 times. So there's a microcap idea. We're going to contrast it with the best, one of the best performing stocks on NASDAQ and out there, period. So in conclusion, now is the time to invest. The current bear market has lasted longer than the 2 previous buying opportunities, the tech wreck, the Great Recession. Many Canadian listed microcaps are more reasonably valued than large caps. It's true. Many Canadian listed microcaps trading at significant or sitting on significant cash reserves, and the worst is nearly over. So keep in mind all of the other things, the 10-year sensation, etc. I think now is the time. I hope you guys have a successful conference and that you find a few of these companies and that maybe a few of these tips that we handed out can help you in identifying some winners for yourself. Thank you for your time.
And for full disclosure, Brent Todd is not an investor in NVIDIA, and he is an investor in the ADF group.